Blog Talk Radio.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network, CREPN Radio. We're so glad you joined us. My name is J. Darren Gross. I am a commercial insurance broker and a real estate investor. And a long time ago, I recognized the importance of learning all I could about commercial real estate to better help my clients. Commercial Real Estate Pro Network and CREPN Radio are my efforts to have and share a conversation with experts on topics of interest to investors and professionals dealing in commercial real estate. The goal is to help those in commercial real estate, and you can find us if you've got your computer on and you got your Google up. You can Google Commercial Real Estate Pro Network. You'll find us on Facebook, YouTube, LinkedIn, and coming soon, cross my fingers, I was talking to the web developer today, we're going to have an old school website, commercialrealestatepronetwork.com. You can also find us on Twitter at CREPRO Network, @CREPRO Network. And how you can help is if you like what you hear, if you like what we're talking about, or you hear a guest that you find fascinating or interesting, and you find that, or you think somebody else might find what we're talking about interesting, like it, comment, share, tell us what you think about it. And if you have anybody that you think might be a good guest, we'd love to hear about that as well. And now that you know who we are and what we're doing, we're going to talk a little bit about today's topic. Now, most of the audience is either invested in commercial real estate or intends to be. If you've ever considered multifamily or would like to grow your portfolio to include more multifamily, we've got a special treat for you today. Today's guest is Stacy Kennedy. Stacy's developed a system to help you with apartment turnarounds. It was back in 2003 that Stacy was rapidly climbing the ladder of corporate success, but going in the wrong direction, are her words. After spending many years of getting her accounting degree and a CPA license, corporate America became her life, and she learned how to tackle chaos within companies and create systems to turn them around financially and operationally. But she knew there was more to life than a 60-hour work week and a job where her efforts built shareholders' wealth rather than her own. And fortunately for us, her struggles led her to learn about investing in real estate. And over the next several years, Stacy started educating herself on multiple ways to invest in real estate, and she became an expert in creative financing. She acquired a master's, as she said, from the School of Hard Knocks, and found herself being drawn to working in the area of multifamily real estate and property management. And after taking over multiple underperforming properties, Stacy started crafting a system to systematically and simply analyze a building, perform due diligence, take over the management, and ultimately facilitate a full management turnaround. And Stacy started to realize that very, very few investors were taking advantage of this hidden gold mine in real estate, and became very passionate about documenting a system, a recipe for the easy 1-2-3 formula to successfully turn around a building and create huge profits, either by selling the building or holding the building and enjoying cash flow and equity. Stacy's invested in seven markets across the country. She's been hired as a coach and a consultant with individual investors, real estate developers, and property management companies in the U.S. and Canada. And with that, I'd like to welcome our guest, Stacy Kennedy, to the program. Stacy, are you there?
I am. Thank you, Darren. Appreciate that intro.
Well, thank you. I can't tell you how excited I am to have you on the program today and talk a little bit about apartment turnarounds. It's clearly a market that is getting a lot of attention here lately. I know it's the one where rents continue to go up. After the the bubble burst, there's a big demand and a lot of play in the apartment market. And but before we go into that, did I miss anything in the little intro there that I read? Was there anything you'd like to add about that as far as your background?
No, I think you got everything. I mean, this will definitely come out as we get into the show a little bit. But I just have a passion. I've had a passion for many years for taking the information that I've learned just through trial and error and trying to create a path for the next investors that are coming up that's not so rocky, and just creating systems that make it easier for people who want to invest in real estate, specifically multifamilies, and maybe take on a management turnaround. Just so it doesn't have to be so hard. It can be something that's easier and enjoyable because it's so profitable. I mean, there's just so much money to be made in it. But, man, there sure is a big learning curve if you don't have, like, a system laid out for you. So I used to teach live boot camps, and, as you and I have spoken offline, so, I have a couple of small children now, so it's been a little while since I've traveled and spoken, but it was absolutely 100% my passion to work with newer investors or investors who are wanting to get more into multifamily and just teach them what I know. So I'm really excited at the opportunity to be on this show with you and just to share my knowledge and see who I can help.
Great. Well, and also for our listeners, I just want to let everybody know that Stacy has very graciously provided a special gift for those that stick around. We'll tell you how to get it, but it's a letter of intent that she's developed over the years. And Stacy, do you mind telling the listeners a little bit about how you got to that and what
Sure.
you've got in the letter of intent?
Yeah, absolutely. So, just over the years, I remember when I was a new investor, one of the things that would just absolutely terrify me was just writing offers. I mean, when I was like brand new, I hadn't done any real estate investing. I remember the first time I was going to submit a handful of offers. I had invested in my education, so this was just single families, not even multis yet. And it came time to actually submit the offers. I remember I was in a dead cold sweat, which I heard those words before, but never experienced it until I went to go make some offers. I thought I was going to throw up. I was so scared. Anyway, and I know that even if someone has invested before in single families, when you're moving into the world of multi-unit, it's a game, but it's a much bigger game. It's the dollars are bigger, and it can be overwhelming and intimidating. So one of the things that's actually pretty cool about commercial real estate is that it's not uncommon at all to have a situation where you submit, rather than submitting a contract that is binding on you as soon as you have submitted it, you can submit a letter of intent. And a letter of intent is typically, in the normal world, a letter of intent is not binding on anyone. It just simply gives you an opportunity to let the seller know that you have interest in their property. So the letter of intent that I'm providing for our listeners it's actually very, very carefully written, and it's written in such a way that it is not binding on the person who is offering the letter of intent. But if signed, it is actually binding on the seller. So, that's just kind of crafty and clever and fun. But the reality is, that's not even the real major benefit of it. To me, it gives you an opportunity to open up a dialogue with the seller, right? We're real estate investors. One of our primary jobs is to be problem solvers. And it's sometimes challenging to solve a problem if we don't know what the problem is. And when there's just a property and you don't have a chance to know anything about the seller, you don't really have any opportunity to solve someone's problem. So one of the things that I like to do, and there's some videos on my YouTube that go into a lot more detail on this, but the gist of it is, one of the things I like to use this letter of intent for is to make what I call ABC offers. And so an ABC offer is, in the letter of intent, I will have 3 different offers on the same letter of intent. And so it would be something along the lines of, offer A would be, a cash offer. Offer B would be a conventional finance offer. And then offer C would be some kind of seller financed offer. So, and the benefit of doing that is, the cash offer, of course, is going to be extremely low. And I'm not suggesting that everyone that you're making a cash offer that you have, 400, 500, 600,000, whatever it is, sitting in the bank. But the reality is, if you make an offer that is low enough and the seller accepts it, you're not going to have anywhere near the difficulty going and raising the funds if it is a fantastic deal. So when you're writing that offer A, that cash offer, it is a low offer. Okay, and also you're not usually trying to get the seller to accept that one unless you really do have the cash sitting in your bank. But that's a way to, just see where they're at. Maybe they just need to get out quickly. And then offer B will be more conventional. You're going to put down a down payment and go get conventional financing. And then offer C is going to be the highest of the offers, and it's going to be a seller finance offer. So, finance is it's always going to be, for most people, it's always going to be kind of the trick and trying to get the funds lined up. And so if you can get your real estate transactions to the point where the seller will carry the financing, or at least a portion of the financing, that alleviates some of the angst over how am I going to fund this deal. So for you, it might be worth paying more. Now, I'm not suggesting you're paying so much that it makes the deal not doable. I will never, ever suggest that. But you might have an offer where A is really, really low in cash and C is higher. Ultimately, that's the one you're really trying to get them to get. But whatever they respond to you on, and usually they don't just sign it and send it back. It'll usually open up dialogue, but it will at least let you know where their seller's at. Are they desperate to get out? Do they need to close quickly? Or, are they okay, starting to collect some cash flow by seller financing it? So anyway, that letter of intent gives the investor an opportunity to make an offer without it being binding, without being terrified that, oh, God, what am I going to do if I get into this deal? It lets you kind of test the waters and get to know the seller a little bit and what their needs are. So that's the ABC, or that's the letter of intent that that I have available for our listeners.
That's terrific. I love your strategy, the ABC, high, medium, and low, if you will, kind of an offer there. And, it's funny, you've said a couple things that just make me just almost laugh and think about how funny life is and how scared I was. Just curious, do you remember your first offer?
Oh, I totally remember my first offer.
Can you tell us just a little bit about your first one?
Yeah, sure. Well, my first offer was actually the one I was referring to. I was making 5 offers at once because I had, I definitely knew going in that real estate was a numbers game, and I never write an offer expecting them to accept my offer because I would write low offers trying to get a good deal. So I'll talk about my first 5 offers since we were doing them at the same time. But I was sitting at, I remember my husband and I were sitting at a table. We lived in Sacramento, California at the time, and we were sitting at our favorite restaurant that's now closed, Sacramento Brewing Company, and I was sitting there with the contracts. The realtor had sent them to me, and I was getting ready to sign them, and I was so nauseous. I couldn't even eat my food. My husband's like, "What? I'm pretty white. I'm white-skinned and very freckly, but apparently I even became even whiter than that, which no one even realized that was possible." And he's just like, "What's wrong?" I'm like, and I was just terrified. I don't know what of, because it's not like somebody could come and like drag me off. They could buy this house, but it was just so new and so scary, and I was scared out of my mind. But whatever, that was the beginning. And I have not told that story in eons, but I'm glad you asked me, and I'm glad it came up just because a lot of people go through that, and sometimes they don't realize that that's really, really normal. It's really normal to be afraid. And, when you're going to be an entrepreneur, you're going to have things that come up that you're afraid of. It's completely normal. The difference between us and the people who will never make a change in their life is that we feel fear. It's not like it's not there. We feel fear, but we make calculated risks, and we act in spite of that fear, and we act accordingly. And sometimes we hit roadblocks, and figure it out and you work your way through, but you act in spite of fear, not you don't avoid things because of it. But it was terrifying.
I'm glad you shared that with us, because I'm just sitting there laughing, and I won't delay here long. I just want to tell you that my first deal, I remember I had a legal pad, and I was sitting at a coffee table in our house, and I was calculating how I could pay each, every payment, how I could pay it faster, how I could get the money so I could pay down, because I was borrowing the money for the down payment, and I was, I'd never dealt with renters before, and I was scared to death that somehow something was going to blow up, I just remember I was doing all the calculations on a calculator that I'd write them down, trying to figure out how I was going to, make the payments, collect the rate, make the payment, collect the rent, make the payment. And it's funny. I just laugh when I hear that stuff. So that's great.
Yeah. Hey, we all go through it.
Yeah. Well, you gotta. I mean, I think what you mentioned there too is something I've kind of come to recognize is that how many people love the topic of the investing in real estate, but maybe you're afraid to ever pull the trigger. They always find a reason not to. Water heaters or calls in the middle of the night or whatever that might be. But whole other topic there. But anyway, appreciate you sharing that, and like I said, I always get a little chuckle out of hearing people's first story there. But let's get into our topic today, because I know you're kind of limited on time. You've got another engagement right after this, so I want to make sure we get enough time to talk about it. But so the topic what we're planning to talk about today is the apartment turnaround. And when you say turnaround, assumably there's a problem that we can identify when you make the offer or when you are doing your due diligence. Can you give us a range of identifiable problems or things that you've seen or things that you look for? What have you found? What's an example of a turnaround type project or property?
Okay. Well, I mean, there's the overriding theme behind a turnaround property is that it's underperforming in some way, and that typically is in the form of rents are not coming in. And that could be because you have a bunch of deadbeat tenants in there. It could be that there's just empty units. It could be that the building is in such bad shape that people don't want to live there. So, but the underlying theme for all of that is it's not performing to the level that it should. You want your building to be performing at 90+%. When I look for a turnaround opportunity, the lower the occupancy or the lower the performing occupancy is, the more opportunity there is, in my opinion. Actually, not in my opinion. It's the more opportunity there is, because if let's say there's a building that's operating at 85%, there's not a whole lot you can do to increase the value, because it's already at 85%. You find a building that, there's a little bit of room, but if you find a building that's operating at like 60%, that's more like it, because now you have the opportunity to go in and through a variety of things, which we can talk about on the call, but through a variety of actions, you can increase revenues on that building and increase the net operating income. So it might have to do with decreasing expenses. That's certainly part of it. But the biggest impact I've found through all my investing career is whatever you can do to increase the revenue of the building. And the lower it's performing, 60%, 55%, the more upside there is in being able to get those revenues up.
Is there a range or you mentioned 85% is kind of a tough one to make it really perform a lot better, but is there a range or that you look for ideally, a target range that you like to make an offer on?
I prefer under 65 if ever possible. It really just depends, and it's hard to say this is the way it always is, because it depends on the deal. But in general, I like to go for buildings that are definitely under 70, but 65 and lower, I feel like it gives me enough room to do something with it. So that's what I look for, and it can be anything from completely vacant, which those are definitely challenging, but completely vacant up to 65%. And that's my sweet spot. But if something's like somewhere in the 50 to 65%, that's great, because you still have rents coming in, so there's some cash flow coming in to help supplement the cost of operating the property while you're turning it around. But there's plenty of room to increase the revenues. So, but really anything under 65, even if it's vacant or only 10% performing. I just have to take into account what the expenses are going to be and what the capital requirements will be while I'm holding it and doing the turnaround, and then I need to plan for that financially, whether it's funding the deal out of investment account or bringing in a partner or borrowing the funds. We just need to be realistic about what the holding costs are going to be during that turnaround time. And if there's more tenants in there, that just makes it a little bit easier. But actually, sometimes it does, sometimes it doesn't. Sometimes tenants are paying rent, but then they're dealing drugs. So that's not ideal. So every deal is, everything is deal by deal. But 50 to 65 is kind of a really, really nice sweet spot. Anything under 65 is good, though.
Right. So let me ask you, so in a turnaround situation, when you find something that's underperforming, do you set any kind of a time frame as far as an expectation to be able to get it performing at a level you'd like it to, or how do you tell us?
Yes.
Walk us through a property. Let's say you find one that's underperforming at, say, the 50%, and tell us how you assess it from the offer, and then how you get it up to speed. What would be your kind of your plan?
Okay. So it's, there's a little bit more that we have to take into account before we come up with a timeline. But 50%, let's say it's operating at 50%, if the building is 25 units, it's going to take a different amount of time than if the building is 75 units, for obvious reasons. So when you have, 50% occupied at 25 units, you have 12 or 13 vacant units. At 75 units, you have 37 or 38 units. So there's a lot more turnaround to do. So we'll use the 25 unit as an example. So let's say I find it's a 25 unit building, it's operating at 50%. We'll submit a letter of intent to see where the seller's at and see if we can find a price that will work. So let's say we go through that process, we negotiate, and once we've come to, I prefer to do this just verbally over email, somewhat informally. And it just depends on whether I can deal directly with the seller or if they have an agent involved and how particular the agent is, whether I can actually have these kind of conversations. But either way, one way or another, we get down to what the price is that we agree on, the price and terms. So at that point, then we'll submit an actual contract, and the contract will have a period of time for due diligence. And the due diligence is going to be an inspection period, which is like a physical inspection period, in addition to having time to review various documents that you're going to need to look at, such as rent rolls and leases and utility bills and looking, and assessing insurance and things like that. So we go through this period of time where we get the physical inspection done. We're going through the due diligence, and we definitely don't have time to get into the details of this, but there's an entire system that I've created around due diligence. The main thing that you need to do if you're going to do multifamilies, regardless of whether they're performing or underperforming, you really need to set up systems to do your due diligence, because otherwise it's very common for owners to give you all sorts of information in like random pieces. And if you don't have some kind of system to collect that information and be able to make some sense out of it, it can be very overwhelming, and you really don't know what you have because you just have piles and piles of stuff. Anyway, if you want to create some kind of system of organization so that at the end of the day, you know who is in the building, what unit they're in, what is their normal rent, what is their current status on rent, how much of a security deposit do they have, do they have a current lease in place, et cetera. You want to create some kind of system so that at the end of your due diligence period, you have a couple of documents that summarize everything. So, and the reason we do that is because once your due diligence period is done, then you're moving in the time where you're going to close on the property, okay? And that transition from not owning it to owning it, that period where you're closing it, that is very, very critical to successfully turning around the building in a reasonable time frame. So if you buy a building and you really don't even know what you bought, you just know you got a great deal, and then you close on it, and it takes you a few months to kind of figure out what's what because you never got the information from the seller. You just have to go in and kind of figure it out on your own, which I've done, but it's hard and it takes a lot of time. That's going to take a lot more time to get, because it just takes you months before you can even really start your turnaround because you don't even know where you're starting. Whereas if you create some kind of system for your due diligence and you know exactly what you're taking over and when, the day that you take over the property, you have a set of letters already ready to go to the current tenants, letting them know that there's a change of management and, where to contact if they have questions or maintenance needs, to let them know that you have that their security deposit has been transferred. Because, if you can put yourself in the tenant's mindset and realize, gosh, if someone all of a sudden found out there's a change of ownership, they're probably freaked out, like, well, wait a second, what does that mean? And what does that mean for me? And what happened to my security deposit? And are they going to raise my rent? So there can be lots and lots of questions and fear from tenants when there's a takeover. So one of the things that you can do to help a smooth transition is provide them with information and let them know, hey, here's what's going on, and everything is fine, and your rent will at this time will remain the same, and et cetera. But if you don't even know who's in the building, there's no way for you to do that. So, and another thing is if you have tenants who have not been paying rent and the former owner did not start the eviction process, then the day you close, you need to get that eviction paperwork going, because you want to get the clock ticking and get those tenants either scared enough that they realize they better start paying you or they're going to get kicked out, or you need to get the clock ticking so that you can get them evicted and get them out and get somebody else in who's going to be a performing tenant. So that transition from due diligence through the actual closing and taking over is really, really important for minimizing the turnaround time. So, but once you have closed on it and you get your current tenants kind of up and running, you've made contact with them, everything is moving along, then you essentially start on your plan. And your plan for doing the turnaround is something you're going to develop during your due diligence period once you know what you have. You know which units that you have that are occupied, where tenants need to go. You can't really do a whole lot with those. You just, file the eviction paperwork, have your attorney do it, and get that going. In the meantime, you're going to start focusing on getting the units that are vacant up and running and taking care of the aesthetics of the building and taking care of any management issues that need to be fixed so that the building is a place where people actually want to live, and it's, it's clean and it's safe and it's an attractive place. So, and I mean, and that means something different depending on the neighborhood, obviously, but you want to get going right away. And if your cash is limited, if your cash flow is limited, then it's completely fine. Let's say you have 12 empty units. It's fine to take 2 units at a time, rehab them, and then while they're rehabbing, you get your management team to start marketing the units and start, showing them, and you start, just doing like 2 at a time. So you get those 2 up and running, you're working on getting those filled, and then in the meantime, you get the next 2 turned over, and then the next 2, and the next 2. And by doing that in a segmented way, you're decreasing the big chunks of money that have to come out, and you're helping to offset some of that cash with the new tenants coming in with their rent. So, I mean, it can take anywhere from a few months up to a year if the building's in really bad shape. But you just go in and you assess how many units are vacant, how many tenants aren't paying, and you should be able to get a pretty good idea for how long it's going to take you. The key is you just need to schedule. You need to set a plan, and then you need to be checking in with yourself, with your plan on a weekly basis to make sure that you're on track. And if you're not, then at least the fact that you're checking in can show you where you need to make adjustments so that you can get back on track and get your building performing as quickly as possible.
No, it sounds like a pretty reasonable way to go about it. I got a couple of questions in mind though. When you assess a property at a percent of performance, do you look straight at whatever the market rent is? Do you like to be right in the middle of a market rent, high end of a market rent, low end of a market rent? Where do you gauge that as far as your percentage of performance?
Well, actually, I'm not actually looking at any of those things when I talk about performance, although we'll talk about that in a minute. When I'm talking about performance, what I'm actually talking about is just how many of the units are rented. So when I say 50%, okay, I don't actually mean 50% of the rental income potential. I'm actually looking at how many of the units themselves are performing.
Just units.
So if,
got it.
Yeah, because, I mean, that's really that's the biggest chunk. I mean, you might have a unit where the market rent is, let's say, $700 a month, and it's only being rented out for $600. Okay, well, there's an opportunity to that gap over time and make up that 100, but that's a small amount compared to the empty units that are bringing in zero. If you have a unit bringing in 600
right,
compared to units bringing in zero, the units bringing in zero are my top priority because that's the biggest opportunity to increase the revenue. And we haven't really talked about this yet, but the reason there's so much potential with doing a turnaround is because the way that multi-units, well, I guess you know this, but the way that multi-units are valued is it's based on the net operating income and whatever the market cap rate is. So the more quickly you can increase the net operating income, which is simply the revenues of the building minus the expenses of the building, the more quickly you can start to increase the value of the property. And then you can either sell it, refinance it, or you're just keeping it as a cash flow property. So that's why it's always my focus, where can I hit where can I make the biggest impacts in the monthly net operating income? And typically that's in the area of, filling units and increasing revenues. And then secondarily, it's typically, decreasing expenses, if you can find ways to decrease expenses in a building that's not being run efficiently. And then third, it would be increasing rents to market rate. That's just usually the last thing that I do, because I want to keep the people who are there while I'm doing the turnaround. And ultimately, if everything else is filled and I really want to get everything else up to market, I can raise the rents knowing, a percentage of the people might move out. But I don't want them to move out until I have the other ones filled. It's just from a cash flow strategy standpoint.
Yeah, right. And keep the units rented, keep the rent coming in. I hear you loud and clear on that. Well, I appreciate you clarifying that on the percentage there. I didn't know if that was a performance, meaning the bottom line, or if that was you're looking at that up front as the number of units being rented, percentage
right.
of the total available. Got it.
That's right. Yeah.
And then, as far as just some sort of set for a timeline for your due diligence, how long do you allow for you to 30 or 60 days to get all the information to in that due diligence period, or is that included in your letter of intent?
It depends on the size of the building and the condition of it, or to the extent that I can't even get that information. But typically 30 to 45 days is a common due diligence period for the projects that I take on. Usually if a building is underperforming, the seller is they're not really in too much. They're not really wanting to hold on to the property anymore. It's probably not making them any money. There's some reason it's underperforming. They're either no longer interested or something in life happened, and they've checked out. They're not engaged. So typically with these kinds of properties, I found that, to do like a 60 or 90-day closing can be a little bit challenging. So if we can get a 30-day due diligence period and a 45-day closing, that's usually going to be more attractive for these type of deals for the sellers, because they just don't want to hold on to it anymore. Obviously, if they would have taken care of their asset, and it wouldn't be performing the way that it is.
No, I'm all in on the system there. We were talking about our first deal, and I can remember the way I bought a couple of properties, and it was just like almost hoping that it would improve. No system in place, and then I came across a system where it's laughable when I think backwards about how I did these things. I knew that I wanted to collect rent. I wanted other people's money, but the actual understanding of all the expenses and all the planning for the contingencies and just repairs, et cetera, were not even on the radar. And I ran across a tool, a worksheet kind of a thing that really kind of spelled it out. And I even remember sharing it with a couple of my investor buddies, and they were going like, "I'd never buy anything because it identified everything that you could really nail down as far as an expense, but what it did is that it very systematically clarified when I was buying a property that it was going to make money from day one, not like eventually, but from day one. And that's when it really opened my eyes, like, wow, this is really a great way to make money, as opposed to something just continue to bleed year after year and hoping that it would, the equity would build, or the mortgage would get paid down, or I could refinance or something like that to make money on it. And so I think that's something that newer investors and people that maybe have been a little gun shy or haven't pulled the trigger yet, is just it's so important to really have your numbers identified so that you can actually make money from day one. And I like your system approach.
I agree. Yeah, that's true. You don't know what you don't know.
Yeah, no kidding.
So it's good to have. Go ahead.
I was just going to say, baptism by fire was kind of my. I got taught a lot by tenants, that's for sure. About.
Yeah, me too.
But anyway, talked a little bit about the approach there, and Do you on time? So once you've got one and you've got it, you've done your due diligence, you've made the offer that's been accepted. Now your letters are going out. I like the fact that you have a communication plan in place where you're going to communicate with the tenants right away, so that any kind of a sense of unknown is alleviated, and now they know that they still have a home. There's some reassurances that the deposit hasn't been spent, and we don't know what you're talking about. Some phone numbers for them to contact if they've got concerns. I think that's really. It's critical for any kind of a negotiation, right? Any kind of a relationship to have communication, and to start off with a good communication. And then also, like you mentioned, the eviction, thing, and just, that's something that if you've already abandoned your rental agreement or your lease, and you're not abiding by the terms of a lease, you're going to have a whole lot longer time required to evict or cure that debt or the back rent, and for somebody not to get on board right away and hold to the letter of the agreement, you're creating a big problem for yourself. So that's great.
Yeah, I don't. When it comes to that non-paying rent, I don't mess around. It's what you pay your rent or you move somewhere else. So it's this is not charity.
No, and I think that's it's you have to. Otherwise, you
it's
won't,
a business.
You won't be a landlord for long. Yeah, exactly.
Yeah, that's exactly right. It's a business, and and I've definitely talked to people before, and especially when someone has definitely feels like bad for people. Well, gosh, where they fell on hard times. You know what? I get it. I totally get it. I have fallen on hard times. Everybody has fallen on hard times, and I know that varies. But you know what? You make adjustments. One of the things you can't do is not pay rent. If you can't pay your rent, then you need to move out, move into family or friends or whatever until you get back on your feet. As a business person, it is not appropriate, nor is it, it's not good for myself or my family or setting up an example for my children to run my business like a charity. I do charity for charity. When it comes to business, it's business. And if there's a tenant that's not performing, they get an eviction notice, and they get a certain amount of time and get caught up. And if it works out, great. I would prefer they not move out, but the reality is, the day after they're late, we start the process so that if they don't get caught up, we're not sitting here going, oh gosh, I guess I should have started that 2 weeks ago or a month ago, and that's all part of the system. That's not part of the turnaround system. That's just part of the way that I run apartment buildings. They do have to be systemized, otherwise it can get away from you very quickly, and that affects, that every single rent dollar that comes in affects your bottom line, not only on your income, but the value of your property. As a quick,
right.
Doing a quick analysis, every dollar that you have, net operating income at the end of the year, has a 10 times effect on the value of the property. So if you have, for example, one unit that you're not taking care of, you're not getting it turned over, and it's, let's make it easy, $500 a month, at the end of the year, that's $6,000 of revenue that is not showing up in your net operating income. That makes about a $60,000 impact on the value of your property. Now, and I'm oversimplifying,
right,
because I'm not going to get into details of cap rates, but that would be in a market that has really a high, a 10% cap rate. Most markets have a lower cap rate, which means the effect of that $6,000 is even more on the value. So,
exactly.
It's really critical that in your turnaround and just operating your building, that you be very, very tight about your systems and you stay on top of your management team. No one's going to watch the performance of your building the way that you will. So anyway, that's why I'm big on, evictions is a big one, just because it lets the tenants know that you're serious. Because people, just like anyone, some people will get away with is whatever you let them get away with. And so that's a way of establishing that that's not okay, and you either pay your rent or you go move somewhere else, and you'll get somebody in here who will pay rent, because that affects my financial legacy for my family and my kids. and you're not taking food out of my kids' mouth. I take that very seriously. So that means I need to be a good businessman and run my business like a business and not like a charity, to make sure that it's doing the best that it can do.
I couldn't agree more with you. And it's funny, on occasion there's a story I hear, or some reason I'm given, and there have been times when I've accepted those stories, regrettably. And boy, once you do accept that story, you're the easy mark. You're going to be the last one paid. I mean, the kids are going to get new toys for Christmas. The house is going to be all decorated, and remember one time, this is probably almost 20 years ago, driving by one of my rentals and wondering why I wasn't getting paid. And I look out in the front yard, and there's new bikes, and the house is all lit up like Christmas. And Santa Claus has been by twice, and I'm still not getting my rent. And I'm going, what?
Yeah.
But,
and it's
anyway.
easy to let your heartstrings get pulled, but the reality is you're not doing anybody any favors by doing that. I mean, we all have responsibilities. We all fall on hard times. You have to address, but they're not. I will always make sure that them paying the rent is as high a priority as I'm able to make it. By my
right,
actions.
and also
all I can do.
By you enforcing it, it will be their priority. That's
Exactly.
the thing I've learned, is when you force it, say,
Yeah.
look, it's either a priority for you or it's not. And if it's not, then I guess you got to move on. So, but enough about that.
Exactly. I agree.
Wanted to ask you a little bit. We've talked about the system, and I know you do some coaching and your systems and stuff. Can you talk a little bit about some of the characteristics you think an investor needs to have, or kind of the mindset for somebody that's going to get in on a turnaround? Is there anything that you've seen or learned, or you can say is kind of critical for somebody to have as far as
Sure.
Getting into something?
Actually, yes, I can. I know that I invested my own education, and I was in the real estate seminar business for many years for one of Robert Allen's companies. I was one of the instructors, and so I'm really familiar with what it's like for people to sit in a 3-day seminar and get all googly-eyed about the idea of mailbox money or passive income. You don't have to do anything; you just make money, and it's so easy. And I was sucked in by that too. I thought, oh my gosh, that sounds so wonderful. Of course, it sounds wonderful, and if it sounds too good to be true, gee, it might just be. So one of the things that that I always taught my students based on my own experiences is, look, there's nothing passive about passive income. It's important to understand the difference. So, yes, there's a difference between going every day and clocking in, or sitting in a cubicle and working your 40 or 50 or 60 hours for someone else. That is very much active income, as opposed to, if you have, apartment building where rents are coming in, that would be considered passive. But I think one of the things that people misunderstand sometimes about that is that it means you don't have to do anything. And that could not be further from the truth. I know this, unfortunately, from very painful experience. I got into a lot of real estate transactions, and I was like, okay, well, I've closed on it. There's nothing else I need to do. Wrong. You need to manage your
right.
team. You need to manage your team. And it doesn't mean I'm not the one in there, banging a hammer and checking toilets. I don't have the slightest idea what I'm looking at. But the reality is I have a team in place, and that if my team is not being led or directed by me, they're going to focus on whoever, the squeaky wheel gets the oil. So it is my job to make sure that I'm setting up systems in place to keep my team on track. So when I'm talking to an investor and they're trying to decide, gosh, do I want to do a turnaround, one of the main things I'm going to do is I want to check their mindset for what their expectations are as far as the level of activity that they're going to have in their deal. And most of the time I've always invested out of state, so I'm not even talking about physically doing it and being there. I don't mean it has to be physical work, but it means you need to be engaged. This is your deal. It's your responsibility. It's nobody else's. And you can highly, highly leverage your time, but you cannot check out, and it's not completely passive. So it's passive in that you're not physically doing the work, but you need to be engaged. So when I'm talking with an investor, or I'm considering somebody for a coaching program, and I'm looking at their application, it's one of the questions that I ask is, are you going to be willing to engage in this process? It's not going to be passive. And there is no passive. If you ever get into a deal and it's completely passive, you're not doing anything, I guarantee you it is going south at some point because nobody is paying attention to your asset if you're not. So anyway, that's really a big one. And when I work with students, I call them students, but when I work with investors, one of the things we do, depending on where they're at in their transactions, is we create systems. So they might have like a weekly or biweekly coaching call with me, and they're going to be accountable to me to having met with their management team. And it's typically over the phone, unless they happen to be in the market where their property's at, but most of them are investing in different markets. But they're going to have to be accountable to me for having met with their team, which keeps them on track and gets them used to having weekly or biweekly calls with their management team to make sure that the turnaround is going the way that it was planned, or if something comes up that was unexpected, that it be dealt with and it not just be swept under the rug. So, you can make adjustments so much more easily in your turnaround project if you know that there's an issue that comes up. But if you're just assuming your management team is taking care of it and you're checking in every few months, it is going to take infinitely longer to turn your property around. In the meantime, you're not getting the income and the value of their property is not going up. So that's really a big one for me, is making sure that the people that I'm working with understand, look, this is your asset. You're responsible for it. You're going to leverage your time by getting other people. You're the leader, and I'm going to teach you how to lead, and I'm going to hold you accountable to making sure you're leading your team. And so I not only teach them how to do that, teach them what questions to ask, and I help them with systems to use with their team, but then I also hold them accountable to make sure that they're leading their team. Because it's not I can't think of the word, but it's not just common sense. I mean, it's something that usually people need to be walked through and held accountable to until it becomes a habit, and then they're fine and they are just used to doing it. But I'd say that's probably one of the biggest ones.
Yeah, no, like you even said, you don't know what you don't know, and learning it, whether you learn it through the School of Hard Knocks or you learn it, actively with somebody that can guide you and show you the right way, so that you don't have to go down that road of hard knocks. You do have to learn it. I mean, I guess that's the thing there. I wanted to ask you quick, because I think my clock says we got just about 5 minutes left here, but I wanted to just ask you briefly about the investing in faraway places. Do you have any kind of criteria as far as the size of the market, or is there anything there that you look at when do you try and stay urban, suburban, larger metro areas, or is there any kind of criteria that you like to see your investors or students work in? Or
I know that probably some people do have that. For me, no, because what I'm looking for is upside. It doesn't really matter where it is. I mean, as long as the market itself is solid. I don't want to go into a market that's declining and losing jobs, things like that. But as long as the market is stable, I'm not particular about urban, suburban, or anything like that, because and if I got that picky, it'd definitely be more difficult to do turnarounds, because they're definitely not dime a dozen. There's going to be fewer of them around. But for me, no, it's really not about that. It's more about what is the potential of the building and what is the current performance, and the difference between the two. If there's enough of a spread, then I'm interested. I mean, you can literally, on a building, you can literally make multiple six-figure profits just by turning around the management, because of that 10 times factor. With one of the examples that when I teach a webinar, one of the examples that I'll give is, look, if you want to increase your bottom line by, let's say, $100,000, so you want to increase the equity in the building by $100,000. It's like, that's 6 figures. Oh, it seems like a good amount, 6 figures. The reality is that all it takes to do that, to increase the value of the building by $100,000, is increasing your net operating income, your annual net operating income, by $10,000. So let's break that down. What does that mean on a monthly basis? That's only like $830-something a month. How hard is it to do to increase the revenue of a building by $800-something a month if it's underperforming? That's filling probably 1.5 to 2 units. That's it. That's
Right.
all that you're doing. Increase it by 100,000. Just imagine if it's only operating at 50 to 60%, and there's a lot more that can be done. I mean, it is a multiple six-figure strategy. Like one of my students from a couple of years ago, I still actually talk to him regularly. He'll call me every once in a while to get some consulting advice. And a property that I helped him turn around back in 2010, he bought it. He bought it as a foreclosure from a bank. This is actually a really, really cool deal. Bought it as a foreclosure from a bank for $210. I think it was $190, and he put about $20,000 into it right away. And he didn't know what he bought. That's why he called me. He was like, "Oh, Stacy, I don't know what I did." I taught him about single families, and then he got into this, and he knew I knew about apartments. So he called me. He's like, I bought this property because it was such a good deal. I don't know how to do it. And so I came on as a consultant and worked with him for about 5 or 6 months. We got the building turned around and got it performing and cleaned up. Well, now here is 2015, and a month ago he got an offer on the building for $750,000. So he bought it for $190, put $20 into it, so he was all in $210, and and it's worth $750,000 now because he did a management turnaround on it. And then he wasn't intending to sell it at the time. He was intending just to create a cash flow asset in his portfolio. But because of the way that multi-units are valued, he created a huge amount of value in that building, and now he's going to make $500,000 on a 26-unit building. So
that's great.
Numbers are not typical, but what is typical is it's not difficult to create multiple six-figure profits when you realize that it's really in increasing the net operating income, and revenue has the biggest effect on that. So I don't care if it's suburban or urban. I want to know that there's potential. That's really what I want to know, as far as increasing revenues.
Right. No, I think that's something, getting comfortable with the far away or whatever. I think it comes right back down to you've got your systems in place and you understand the systems, and you've got your team in place and the potential. And I think, just again to reiterate that whole cap rate thing, I mean, like you said, $100,000, it's not $100,000 in 1 month. It's that incremental amount in a month, and you multiply it out by a year, and then the 10 times based on the valuation. That's how you get that, and that's huge.
Yeah, it happens very quickly. The value change, the value for multifamily it's just so different than single families. It can be a life changer. That's part of why I'm very passionate about this particular strategy, and also teaching it. I feel like even one deal can completely change someone's life, and it's worth doing. It's more work than doing a single family home where you just have one unit, because you're actually having to manage a team. But man, the pay sure is a lot higher and worth it.
Right.
So
right.
I'm really passionate about that.
And I'm wondering, is your website 100krealestate.com? Is that how you play on the 100,000? Is that how does that have a meaning there?
Yeah. Well, back when I met, everybody has a mentor and a coach, and so do I. Mm-hmm. Several years ago, I went to him and I said, I have all this amazing knowledge, but I don't know what do I do with it? So he had taught me about how to create a home study course, and anyway, so at the time that I was creating that, he was helping me to figure out, how do you position this? And that's where it came out of it. Because he said, well, tell me about why would somebody want to learn this? And I said, because they can make six-figure profits so easily if they just learn the systems. And he said, you mean six-figure, they can make $100,000? And I said, well, yeah, I mean, that's on the low end, but yeah, so that's where it came from, 100krealestate.com. It was kind of in the early stages of figure out how I could communicate this knowledge out there, but yeah, 100krealestate.com, that's where it came from.
Well, that's great. Yeah, I'm looking at my clock here, and I think we're just about out of time. I want to make sure we're able to get you off to your next appointment. But I wanted to first remind the listeners that if they go to the bottom of the Blog Talk Radio show description, there's a link on the bottom there to get the letter of intent that Stacy's offered us. And so please go check that out and get that and put it to use. And get out there and find a property and do your due diligence and try and make your 100K. Stacy, is there anything you'd like to say quickly to close here? Is there any ways for people to get in touch with you if they have any questions or?
Well, you feel free to visit the website. The website is, it's 100, like 100, 100krealestate.com, and I have a lot of free resources on there, and I have a lot of YouTube videos. There's a lot of information that I just put out there. It doesn't cost anything. Just can start to help you build your knowledge, and and ultimately, certain students decide that they want to have more education. They want to work with me one-on-one, and then that help is available. But if you just kind of want to get your feet wet and just start to build your knowledge, go to the website. There's tons of stuff there, or go to YouTube, and my channel is called 100K Real Estate. There'll be lots, or you could probably just Google my name and apartments, and I'm sure a bunch of the different YouTube things will pop up. But there's lots and lots of resources there, and I'm happy to to have you guys use them.
Great. Well, hey, Stacy, I just want to say thank you again for coming on today and talking with us about apartment turnarounds. I'm sure the audience is going to enjoy listening to this. And
my pleasure,
hopefully,
Darren. Well, thank you for having me. I appreciate it.
You got it, and hopefully we'll be able to talk again soon.
That would be awesome. I would look forward to it.
Great. Now, before we close, just want to remind all of our listeners to please like, share, comment, and tell your friends, share in your network, Commercial Real Estate Pro Network. Let's see, what else I got to tell here. So, remember, you can find us on Facebook, YouTube, LinkedIn, and Twitter. And again, coming soon, we'll have commercialrealestatepronetwork.com. Until then, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.